The Federal Reserve did not just make a routine policy move. It confessed. That is the first thing I want you to understand. The public heard a hold. The market heard a signal. I heard something even more serious than that. I heard an institution admitting, without ever saying the words, that the menu of real choices has almost disappeared. That is what matters here. Most people still think the drama is in whether the Fed cuts, hikes, or waits. That is how small investors are trained to look at the world. They are taught to stare at the decision as if the decision itself contains the story. It does not. The story is the trap behind the decision. If a central bank holds rates because it has several good options and chooses the least imperfect one, that is normal policy. If a central bank holds rates because every other available option produces a worse fire than the one already burning, that is not normal policy at all. That is paralysis. And a paralyzed central bank changes the value of every dollar claim in the system. That is why this meeting matters. Not because the press conference will sound dramatic, because the mathematics beneath it already are. I have spent too much of my life watching monetary authorities pretend to manage events that are already managing them. The language is always tidy. The statements are always balanced. The confidence is always performed. But every once in a while, the arithmetic corners the institution so completely that the difference between official language and real condition becomes impossible to ignore. That is where I think we are now. The Fed cannot comfortably cut. It cannot comfortably hike. And it cannot tell the public that the real problem is no longer simply inflation or growth. But the collision between inflation, growth, debt service, and a political system that still wants the benefits of easy money without admitting the price of it. That collision is what gold hears long before the crowd does. Now let me say something that will sound harsh, but it is the cleanest way to frame the whole issue. A central bank with room to maneuver can stabilize a cycle. A central bank with no room to maneuver can only redistribute the damage. That is the entire difference. And once you understand that difference, you stop asking whether the Fed has a clever move left. You begin asking which asset classes are about to absorb the truth that the central bank can no longer prevent. That is the adult question. The childish question is whether Jerome Powell sounds calm. The adult question is whether the machine underneath him still works. Look at the arithmetic. Core inflation is still running above target. Oil moved back above levels that inject fresh pressure into energy, transport, food, and everything else that depends on them. Growth is weak enough to make a higher rate environment increasingly painful. Unemployment is climbing. Manufacturing is soft. Consumers are already carrying tariff pressure before the full oil pass. Through has even settled into the official numbers. And above all of this, it's a sovereign debt structure that must refinance an extraordinary amount of obligations into a world where money is no longer free. That is not one problem. That is a conflict among problems. If the Fed cuts aggressively, it risks reopening inflation pressure into an economy already receiving cost shock from energy and geopolitics. If it hikes, it risks detonating the debt mathematics not only for households and companies, but for the sovereign itself. If it holds, it concedes that the trap is real and hopes language can buy time. That is the current policy framework in its most honest form. Hope with a podium. Now, I am not interested in theatrical anti-central bank speeches. Serious investors do not need moral outrage to understand a constraint. They need a map. So let me give you the map. The first force is inflation persistence. This is the oldest enemy of paper confidence. And it always matters more than the crowd thinks when debt is large. People see a number like 3.1% and think, well, that is not the end of the world. Fine, on its own, perhaps not, but the number does not live alone. It lives inside a debt structure, inside an oil shock, inside a slowing economy, inside a political environment demanding cheaper money, and inside a world already questioning the neutrality of the dollar system. That is very different. Inflation in a strong, disciplined fiscal environment is one thing. Inflation inside a debt, saturated political system is another thing entirely. Because the more indebted the system becomes, the more painful discipline becomes. And once discipline becomes politically expensive enough, the market begins understanding something very unpleasant. The official inflation target may remain 2%. The real tolerance for inflation may be something quite different. That is when gold starts listening more carefully than the public. Now add the second force, the refinancing wall. People toss around giant debt numbers so casually that the numbers stop feeling real. That is one of the most dangerous habits in finance. When a number becomes too large for the mind treats it like wallpaper. But debt is never wallpaper. It is a future claim on policy. If the United States must roll trillions of debt into a rate environment far above the one in which that debt was issued, every percentage point matters. Every basis point matters, every weak auction matters, every failed fantasy about easy cuts matters. That is because refinancing is where yesterday's cheap promises meet today. Expensive reality, and reality is not polite. A government can borrow recklessly for years and still look competent, as long as financing remains generous. The whole illusion depends on the rollover. Once the rollover becomes expensive, the debt does not merely sit there. It begins eating the future in visible pieces. Interest expense rises, deficits worsen. More issuance becomes necessary, more issuance requires more buyers demand more yield, higher yield worsens the interest expense. Again, that is not a slogan, that is a machine. And the machine does not care whether the central bank wishes it would slow down. This is why I keep saying the real issue is not whether the Fed cuts a quarter point here or there. The real issue is that the sovereign itself is now a rate-sensitive balance sheet. Once that happens, every monetary move carries fiscal consequences the public is not trained to respect. That brings us to the third force, the quiet liquidity bridge. This is one of the oldest habits of modern central banking. When direct rescue becomes politically ugly, institutional language changes before institutional behavior does. If the public would react badly to the phrase quantitative easing, then the central bank invents a more sterile phrase. If money creation sounds too alarming, it calls it reserve management. If the same old medicine now carries a worse stigma, the label changes before the dosage does. I have seen this trick too many times to be fooled by it anymore. When an institution quietly creates tens of billions a month to support treasury absorption and insists it is not really doing what the public fears. I hear the same message every time. The open market is not taking enough paper on comfortable terms, and the institution is trying to buy time without using the words that would alert the crowd to the meaning of what it is doing. That is not a neutral detail. That is a signal. A system that can finance itself cleanly does not need euphemism. A system leaning on euphemism is already halfway to admission. Now, let me speak about the Federal Reserve's own balance sheet, because this is where the situation becomes almost comical if it were not so important. A central bank that spent years buying low-yield assets while rates were pinned near zero now sits with those assets in a much higher rate world. Meanwhile, it pays commercial banks elevated interest on reserves parked at the Fed. The spread works against the Fed. Losses accumulate in an ordinary institution. Persistent losses of that size would force a reckoning in plain language. A central bank does not live by ordinary language. It can rename the problem. It can classify the whole differently. It can treat accumulated losses as a deferred asset and keep the show running fine. But investors should not confuse accounting permission with economic strength. That is the distinction. The Fed may be allowed to carry the losses. It is not allowed to make the implications disappear. If the institution managing the world's reserve currency cannot normalize without damaging itself, that matters. It tells you that the problem is no longer just out there in the economy. It is inside the machinery itself. And once the machinery becomes part of the problem, the value of hard alternatives rises. This is where the gold framework becomes so important. Most people think gold moves because of fear. That is too crude. Gold moves in stages. The first stage is quiet official accumulation. Central banks, sovereign funds, and institutions that think in reserve terms begin moving before the public has a narrative. They do not care whether the chart looks exciting. They care whether the reserve architecture is changing. That is the calm stage. It is deliberate. It is strategic. It is easy for the public to ignore because it does not feel dramatic enough. Then comes the second stage. This is the stage I believe we are entering now. The second stage does not begin when money printing is fully undeniable to everyone. It begins when the market realizes that the central bank has no clean exit and will eventually have to choose currency compromise, financial repression, or overt liquidity expansion on terms worse than the public currently imagines. That realization matters more than the official act. Markets reprice inevitability before official acknowledgement. That is what Phase 2 really is. Not panic recognition. Recognition that the institution can no longer resolve the crisis with ordinary tools. Recognition that one path feeds inflation, another feeds recession, and a third feeds debt stress, and that none of these can be solved without damaging the dollar. That's clean credibility. That is why gold's largest moves in history have not usually begun when the public finally agrees. There is a crisis they begin earlier when the public still thinks the central bank may somehow find a respectable way through, but the math has already ruled that out. Then comes the third stage. That is when the quiet bridges become louder, the euphemisms become insufficient, the public joins the trade, and the move becomes obvious enough to be expensive. That is when headlines catch up. That is when ordinary savers finally say, maybe I should own some gold. By then, the easy part of the repricing is already gone. This is why the second stage is so powerful. It is the stage where the institutions are no longer alone, but the crowd is still late. That is where the asymmetry is greatest. Now, I want to explain the three triggers that convince me this second stage is beginning in earnest. The first trigger is the refinancing trap. This is the simplest and the largest. When the government must refinance enormous amounts of debt while interest expense is already massive, the central bank loses the luxury of pretending rate policy is only about inflation and employment. It is also about sovereign survivability. That changes the whole meaning of the rate decision. A rate hold is no longer just a hold. It is a signal that the institution is trapped between inflation pressure and debt service pressure. That is a Phase 2 signal. The second trigger is a succession trap. Markets do not only price current policy, they price the expected political environment around future policy. If a central bank chair is nearing replacement and the incoming political pressure is openly tilted toward cheaper money, regardless of the data, the market does not wait politely for the next chair to walk in and make the move. It begins pricing the compromise as a probability that matters enormously. A central bank under visible political pressure has already lost part of the aura that gives its words power. It may still act independently in moments. Yes, but the market now knows the pressure is real, and that knowledge changes the meaning of every future hold, every future cut, every future refusal. The institution no longer stands above politics in the old imagination. It now stands inside a power struggle while inflation, oil, and debt continue worsening the arithmetic. Gold hears that the third trigger is the private credit trap. People still underestimate how much fragile leverage sits outside the public imagination. Private equity, private credit. Zombie funds that should have marked reality long ago, but instead have been surviving through delayed recognition, internal financing tricks, secondary transfers, and the hope that easier money would return before the real damage had to be booked. That hope dies hard, but when a slowing economy meets higher carry, tighter refinancing, and weaker exit conditions, the private world eventually delivers its bill to the public world. Then the banking system feels it, then the central bank feels it, then the liquidity bridge gets wider no matter what polite name it is being called. That is why I think the trap is complete. It is not one problem. It is sovereign financing stress, political pressure for easier money, and private leverage waiting to be socialized into the same institutional balance sheet. That configuration is not a routine hold. It is Phase 2 architecture. Now let me say something important about the dollars, because many investors still misunderstand the order of events. They think the dollar must first collapse visibly. Then gold responds. Sometimes, but often, the more important shift is subtler. The dollar stops behaving like a perfect haven in conditions where history says it should. The long end of the Treasury market refuses to rally cleanly when fear arrives. The market demands term premium rather than granting blind subsidy. The institution managing the currency starts using quieter and less honorable language for increasingly familiar forms of support. These are all early-stage signals that confidence is no longer automatic. That matters because automatic confidence is what made the old system so powerful. The dollar did not merely benefit from trust. It benefited from habit. The market assumed the Fed had room. The market assumed Treasury demand would appear. The market assumed inflation would ultimately be disciplined. The market assumed debt service would remain manageable enough not to distort every future decision. Those assumptions are now under pressure all at once. That is not the end of the dollar. It is the beginning of a repricing of the privilege attached to the dollar. And once that repricing begins, gold does not need a full currency collapse to justify a much higher level. It only needs the market to understand that the range of acceptable monetary compromises is widening and that every one of those compromises dilutes the clean case for holding too much wealth in plain dollar promises. That is enough. Silver enters this story in a different way. Gold is the reserve metal. It speaks first because it sits closest to monetary credibility. Silver is wilder. It is half reserve instinct, half industrial necessity that gives it an explosive quality in later stage moves. Once gold leads and the market broadens the thesis from quiet central bank trouble to general monetary repricing, silver often responds with more violence than gold itself. The reason is simple. It is a smaller market. It carries dual demand. And investors who missed the first part of the gold move often crowd into silver, looking for leverage. That is why I never treat silver as a calmer alternative. It is not calmer. It is a faster horse when the track shifts from caution to momentum. Gold miners add another layer again. People misunderstand miners because they assume a rising gold price means a miner simply rises 1-for-1 with the metal. That is not how the economics work. When gold rises and the cost base does not rise nearly as fast, margin expansion can become dramatic. That is why miners can behave as leveraged expressions of the metal. In the early phase, the public does not trust them. In the later phase, the leverage becomes impossible to ignore. That is where fortunes can be made or destroyed depending on whether you buy sound operators or cheap stories. And that brings me to an important point. I am not telling you to become reckless. Phase 2 is not a license for sloppiness. It is a demand for structure. You still need quality, you still need liquidity, you still need sane sizing, you still need to distinguish between owning a metal, owning a miner, owning a broad precious metals vehicle, and owning a speculative dream someone packaged as exposure. Structure always matters. But if you understand the phase correctly, you stop requiring absolute confirmation before acting. You begin accepting that the best prices rarely coexist with maximum emotional clarity. That is what separates serious investors from the crowd. The crowd wants the move to become obvious first. The serious investor wants the arithmetic to become undeniable first. Those are different standards. Now let me bring this back to the person with a retirement account full of dollar-denominated assets, because that is where the consequences become personal. A lot of ordinary savers still think their main problem is market volatility. It is not. Their main problem is that the denominator itself is entering a more compromised era while they remain heavily concentrated in claims built on the assumption that the denominator will remain disciplined enough to anchor everything else. That is the hidden risk, not just whether stocks go up or down, whether the entire pricing system must begin adjusting to a central bank that can no longer cleanly serve both the currency and the debt structure at the same time. If I believed the Fed still had ample room, I would think differently. If I believed the debt load were ordinary, I would think differently. If I believed oil were falling, inflation were safely subdued, private leverage were modest, and political pressure were quiet, I would think differently. But that is not the world we are in. We are in a world where the central bank must increasingly choose which constituency absorbs the pain: bondholders, savers, workers, borrowers. And whenever a central bank starts redistributing pain instead of solving it, gold becomes much more interesting. That is the real lesson, not apocalypse redistribution. Now, let me tell you what I would do in a world like this. I would reduce my dependence on long-duration nominal promises as a supposed haven. I would respect liquidity, but I would not worship cash as though cash itself were immune to the broader repricing. I would own some gold without embarrassment and without apology. I would think carefully about selected silver exposure. I would treat precious metals miners as a higher risk, higher upside satellite rather than a core substitute for the metal itself. I would favor businesses with real pricing power over businesses whose valuations still assume a clean return to the old money regime. And above all, I would stop asking whether the Fed sounds composed and start asking whether the machine beneath the words can still accomplish what the public assumes it can. That is the question that matters, because central bank credibility does not break all at once. It erodes in stages. And when it moves from stage 1 to stage 2, the investors who understand the transition get a chance to act, while the majority is still comforted by tone. That is the window. The window does not stay open forever. Once the public sees it clearly, prices will already have moved. That is why I'm so forceful about this. Not because I enjoy fear stories, because I have seen too many people wait for the all clear signal and pay for that wait with much worse entry points and much smaller upside. They confuse official language with real condition. They hear hold and think stability. Sometimes a hold means stability, sometimes a hold means the institution is too trapped to do anything else. Learning the difference is one of the most profitable skills an investor can possess. So here's the final choice. You can watch this meeting and tell yourself nothing important happened, because the Fed did what the market expected. You can hear calm language and conclude the system still has room. You can assume that quiet liquidity operations are technical details, that debt refinancing is a Washington problem rather than an asset pricing problem, and that gold's best move still belongs somewhere in a distant future after official confirmation arrives. Many will, or you can do the harder thing. You can understand that the meeting did not reveal a decision. It revealed a constraint. You can see that the Fed is not calmly choosing among good options, but nervously balancing among bad ones. You can recognize that gold does not need the crisis to become obvious. It only needs the market to grasp that the central bank is already cornered. And you can position accordingly before the crowd translates the arithmetic into a story simple enough to repeat. That is the edge, not prediction, recognition. Recognition that the machine has entered a phase where the public story still says control, but the mathematics already say concession. And when mathematics and messaging part ways, I know which side I prefer to believe. I prefer the math, because the math is what gold has been listening to all along.